Will raising interest rates tank this economy?
It's Brian Preston, the money guy.
Brian, I am so excited about talking about this today because I think it's on the forefront of everyone's mind. We know that this year has been interesting to say the least, at least when we think about it from an economic perspective and a market perspective and an inflation perspective. And so a lot of folks are asking the question, hey, I see things happening out there macroeconomically. What does that mean long term? And more importantly, how is that going to affect me in my army of dollar bills?
I mean, this is a unique time. I mean, I've never in my, I can't say lifetime because I was around, but I wasn't a, grown, productive adult at the time that we went through this last time. And interest rates, I mean, the way the Federal Reserve is cranking on the rates with inflation out there, it's created some unique things. Truthfully, it's created a first in Money Guy history. Yep. And that's saying something because really, we started doing this show in 2006. And in show prep, we were like, hey, what if interest rates, if you look at the Fed funds rate from when we started this show in 2006 to where we are now, you'll notice there is an ocean of period of low interest rates. I mean, but we started high. I mean, if you look in 2006, you can see that the Fed funds rate was over 5%. But then ever since then, we had a pretty steep drop down the mountain, went into this valley. I'll just say we're on ground floor with interest rates really from 2008 all the way to 2015. We were keeping interest rates in the cellar. And then you had to walk up the mountain with, incremental increases over time. But then what did the government do as we hit the pandemic? They dropped it. I mean, they slashed rates. I mean, it wasn't even incremental. They just basically gutted the interest rates. And so if you look at the history of this, we've been in a super low interest rate environment the entire time I've been creating content. And now we've had this steep increase. I mean, they are creating their own little hockey stick because they haven't been doing a quarter point here or an eighth of a point. They've been going full on three-quarters of a percent pretty much every Fed funds meeting. So that's created a unique opportunity that we want to talk about. Hey, what does this mean? Is there good stuff that comes from this? Is there bad stuff? Is there ugly stuff that you really need to be aware of? We felt like what better source than the Money Guy Show just to kind of load you up with how to navigate this.
Yeah, it's really interesting, Brian. You said we've been in this declining or flat rate environment. And full disclosure, none of us know what the future is going to hold. None of us have a crystal ball that suggests, oh, this is what things will look like 6 months, a year, 2 years, 3 years, 5 years down the road. But it is interesting. If we are in a rising rate environment and we continue to be in a rising rate environment, there are some things we think you ought to know. Some good things, but also some bad things, and maybe some uh-oh things that you should be aware of when it comes to how you make financial decisions.
So let's kind of jump into the bad first. But I didn't, look, we all know the sayings, the good, the bad, the ugly. But I can't end on ugly, so we're going to do the bad, the ugly, the good. So dropping right into the bad, I think it's interesting. This is an inflationary period. Now, I lost the content meeting where I wanted what a loaf of bread costs in like 1972, what a car costs in 72, and what it costs now, or slashing that dollar bill visual. But it is interesting that we are definitely in a historically high interest rate environment with inflation.
Well, and one of the things that happens is people get excited. They say, oh man, look, cash is paying this, rates are rising. And while it could be exciting that high interest accounts and your cash-bearing, interest-bearing accounts could be paying around 2.5%, 3%, in a vacuum, that sounds good. That sounds like an okay thing. But when you actually look at it in the context of the other things going on out there, namely what you just said, inflation, maybe it's not quite as attractive as we thought.
We're in a period where your savings account probably pays you absolutely nothing in the past 10 years. If you were at a brick and mortar, maybe you got 0.3. If you went with an online bank, they were paying under 1%, but you at least felt like you were getting something. So I can understand the excitement when you might be getting close to 3%, even potentially 3.5% by year end. You're like, hot diggity dog, I'm making money with my interest again. But Guys, check out this spread. We've put together a chart through Y Charts, and it goes from the 2000s to 2022, and we have the spread between the 3-month T-bill, which is kind of the equivalent of cash and money markets, to what inflation's doing. And you'll notice that this is essentially a false trap in the fact that, yes, you're making more money, but that spread of what things are costing is substantially higher. And that is a trap because if the purchasing power is being squeezed, you might be in trouble with the feeling like you're in the comfort of cash, because I get it. Is that whole people are scared of taking risks.
Sure.
You feel comfortable in cash, but if you're losing purchasing power, that's a horrible thing in the long term.
And what's really interesting is when we look at this last, 22-year period, more often than not, what you're making on cash is not keeping up with inflation. Now, a lot of people don't remember this, but back in 2006, 2007, money market accounts were paying somewhere between 4 to 5%. But really since then, they have been in the doldrums. They've not been paying a lot. We saw a little bit of a tick up back in 2019 where it sort of peaked and then it came back down. So now it's starting to rise again, which again is exciting. But I don't know that it is the safe haven that a lot of people think it is, because right now we're in this unique paradigm where what we think is safe could actually be risky, specifically as it relates to your long-term purchasing power protection.
Well, and I think this goes to the headline that we started the show with. Will interest rate increases tank the economy? And the Federal Reserve and all the central bankers are in this weird pickle of a situation where they are trying to slow things down so that inflation can cool down.
Yep.
And I get that, but man, oh man, the ride, I mean, it feels like a roller coaster right now. And that's the part, but I saw, as somebody, one of you out there, my financial mutants, you reminded me, you don't get hurt when you ride a roller coaster unless you jump off.
That's right.
So
That's exactly
we're
right.
still in mid-process here, but I also want to talk about another bad thing I've seen with these rising interest rates. Mortgage shopping has gotten really complicated. We've been in a period of time, Bo, where really for the last 10 years, the last decade, if you were buying a new house, it was just, you didn't think about doing a variable mortgage rate. You'd be like, okay, am I doing a 30-year mortgage? Am I, doing a 15-year mortgage?
And that's pretty much the only decision you had to make.
Yeah, because we were in a historic low interest rate environment. Why in the world would you consider letting anything that could be adjustable into that decision-making process? Things have changed.
And for those of you who are perhaps new to home buying or new to owning real estate or new out there in the workforce, you may not even recognize that when it comes to mortgages, there are two different types. There are fixed rate mortgages, fixed rate loans, and there are adjustable rate loans that most often have some sort of fixed period, but after that period expires, your rate adjusts. Well, rates have been so low, people have not been attracted to the adjustable rate mortgages because it was much easier to lock into the fixed rate. Well, now, as we've seen rates rising, it's our opinion, and we are seeing this a little bit, that adjustable rate mortgages are going to become more into the forefront of people's minds as a way to potentially get in homes that we're not able to get into.
And even though this is under the bad section, I do feel like it's important for us to kind of talk about what are some ways to navigate this, or at least understand what's going on, Bo. So we created a kind of an illustration chart, but walk them through what considerations you should take.
Yeah, so right now, if you look at the rates on adjustable rate mortgages, right now the average is about 6.15%, which is lower than fixed rate mortgages. On fixed rates, the 30-year fixed is about 6.87 and the 15-year fixed is about 6.17%. Well, when you compare the two, adjustable rate mortgages have a lower initial rate most often, but especially on relative to a 30-year product, where fixed rate mortgages have a higher additional rate, especially when you consider the 30-year fixed product. Well, if mortgage rates go higher, if rates rise, when you get past the period where the rate adjusts, you could actually be paying more. Your mortgage could become more expensive with an adjustable rate mortgage. On a fixed rate mortgage, if mortgage rates decrease, it's okay. You can just refinance, which is really what a lot of home buyers have been doing for the last 15 to 20 years. They bought in at a certain rate, and then as rates dropped, if they stayed in their current house, they just refied and dropped the rate and dropped the rate and dropped the rate. Well, when mortgages start moving, when mortgage rates move the other way, you don't have that same level of flexibility. But if you are someone who's going to be in a home for a shorter period of time, you don't think that this is a long-term purchase, maybe you're only going to be there for 5 years, 7 years, 10 years, an adjustable rate mortgage might make sense because you can often lock those terms, a 5-1 or a 7-1 or a 10-1 ARM. If you're going to be in a house long term though, and you think this is going to be the house that you're going to be settled in, even though rates are higher right now, it still may make sense to go ahead and lock in that fixed rate. And then if rates do drop lower in the future, you do have the ability to refinance, but you protect yourself from being trapped in an adjustable mortgage that keeps getting more and more and more expensive.
You covered a lot of ground there, and I love that I get to kind of come back and give the overreaching thing to pay attention. Realize any home purchase, I don't want you guys to even consider making an offering unless you can be in that house 5 to 7 years. I think that's the first thing, because we've been in a weird real estate marketplace. You really do need to be thinking more longer term, not, don't feel the pressure of social media and others who tell you, hey, even if you're going to be in there for 3 years, that's enough time. No, I think 5 to 7 years, you still got to make it through that gauntlet first. But it is one of those things, like I know military folks get relocated, and if you are in a community where you think that within that 5 to 7 year period, you could be changing and you're about absolute on that thought process, there is nothing wrong with at least doing the research to figure out what is a 5 year, what is a 7 year, when I make it through that locked period, how much can they raise it at a time? Because sometimes they will have a period where they can only raise it so much over different increments of time. Go do the research on this. Don't just go with the default. The bad part of this is that the process of buying real estate is already not easy, but this adds additional complication and additional research that you need to do to make sure you're making really good, sound financial decisions.
Another bad thing, Brian, is it's not just mortgages that have gotten more expensive. When rates rise, generally speaking, all debt becomes more expensive. When you think about the way that we go about paying for our lives, it's not just on the housing side. It's not just on the mortgage side.
Yeah, let's kind of go through some of these, because I worry about the weight of the obligations, the debt chains, if you wanted to say, because I think we are one of the unique financial channels where we don't badmouth debt all the time.
Sure.
But we're definitely chainsaw scared of debt. You've heard us make that analogy. We've even told you, please don't sell them pinchers like some of you have done, where we think that debt is a tool, but it's one, just like your chainsaw is a tool. It's a dangerous tool, because if you make one or two mistakes with it, it could be pretty catastrophic. And I think that now that interest rates have gone up, debt, the burden or what it can do to hurt you is becoming even more troubling. And look at credit cards. Credit cards, over the last 10 years, the interest rate charged by credit card companies already 12.98 or close to 13%. That, to me, that feels like that is punitive.
Sure.
Because if I'm telling you we can build $1 million off of 8 to 10%, and then you find out the credit cards are making 12 to 13% in this low interest rate environment.
There's a reason they have the big buildings.
Like, whoa, I see how these guys are the house. They're the ones that are doing so well. Well, fast forward now, credit card debt is now 18.44%. Guys, how do you recover from that if you're carrying any type of credit card debt? Be very aware that debt being more expensive is so punitive, you are turning compounding interest upside down on you. Auto loans.
Yeah, it's not just credit cards. When you look at cars, and you have to remember, the last 10 years has been unique. And I do not worry, that's the wrong word to use. But I do think it's important for folks, again, that are just getting out into the working world, that are just starting their careers, that have maybe only been doing this for the last decade or so, to recognize the last 10 years have been unique. Not a different paradigm, not a different universe, but they've been unique. We have been in a low interest rate environment. So when you look at like auto loans, the average auto loan over the last 10 years has been about 4.6%, but it was not uncommon to go to a car dealership and see someone offering 0.9% financing, 1.9% financing, 2.5% financing. As rates rise, those types of offers may be fewer and farther between. And we're already starting to see that increase. Over the last 10 years, the average auto loan is about 4.6%. As of right now today, the current average auto loan that's being offered is 5.7%. So the average has gone up by a full percentage point. If rates continue to rise, I think we're going to continue to see that increase.
Well, I think it's even worse in the fact that whenever we pull up any historic data, there's a lag. Without a doubt, over the probably next 2 to 3 months, you're going to see auto loans, I think, be in the 6 to 7s. We might even reach the 8%, depending on what the Federal Reserve does with rates. And that translates, think about student loans. Now, student loans, we're in this weird period where because of the pandemic, the federal government has been basically saying, hey, no interest is accruing on all the government-owned federal debt out there for student loans. And then we've even got this whole debate over the $10,000 that could be forgiven. But I want to make sure that anybody out there who's in college age or you have children who are quickly approaching college age, you've got to be very aware that I think we're headed towards a period where student loan debt is going to be in the 6, the 7, even that could be in the 8% range. Guys, measure twice, cut once on this student loan debt. I mean, when you hear somebody talk about debts that could potentially be good for you, I always talk about mortgages, you talk about student loans, but I got to tell you, I'm so worried that we've turned the institution of education into a negative, that you've got to be careful making sure that this debt is something you can process afterwards. That's why we always, just like auto loans, we have 23-8, meaning 20% down. Don't finance to do that amortization over 3 years, and then make sure that the monthly payments don't exceed 8% if you annualized it, but you're basically taking 8% times your gross income, dividing it by 12, make sure your payments don't exceed that. Student loans, I want you to put some guardrails up that your first year of income coming out of college, you don't let that student loan debt exceed that, because, guys, if you get too much of this debt, it really is going to become a weighted chain. In the past, it might have looked like it was just a gold chain around your neck. You put your favorite charm on there. But soon, it's going to look like these are the type of chains that you struggle to pull them out of the back of the Jeep because you need to winch yourself out. It's going to weigh you down. I'm just telling you, be very careful. All debt is more expensive. That's why we put it into the bad column. It could be very dangerous to your financial future.
All right, so those are all bad things, but the reason they're just bad is because some of this is manageable. We can obviously manage the credit cards. We can manage the auto loans. We can manage the student loans. We can manage the type of mortgage that we're taking out and the additional complication. But there are, when you think about a rising rate environment, there are some ugly things that are true about that. And there are some things that we all should be aware of as we go about making our financial decisions.
Yeah, and this is the ugly. I mean, it's just, ugh. I mean, this is the parts. I want this to be part education, but also be part awareness of things to really be paying attention to, especially on the macro scale of things, because we're going to focus on here in the United States. But I want you to know, this is not just an American problem. Right. This is a global problem. If you look at all the Federal Reserve and the central bankers across the globe, they have all really leaned hard into debt. And that's kind of a problem now that interest rates have gone up, because look at this. We ran a federal debt by president. Now, remember, on the show, we don't do politics. Yeah, we don't do. And by the way, our chart, I think it's hilarious when you look at this. It's non-political because the only one that's sitting up there like a gangster when it comes to debt is Bill Clinton. I mean, if you look at this, everybody pretty much is in double digits except for Bill Clinton and then President Biden. And President Biden, this has only got 1 year of data. Sure. So, I mean, give us all time. But it is amazing if you look at how every one of the presidents, if you look at the federal debt by president, we've creating a mountain. Yep. I mean, I've shared, guys, in 1992 was my first vote. I voted for Ross Perot because I was worried about the country having $6 trillion of debt. Man, we have made a mockery. Now we're over $30 trillion of debt. I mean, it is so unique what we're doing with debt. I've always, even as a young person, voting in my first election as that 18-year-old, I think I was 18. I have to go do the math on it real quick. But it was one of those things, I was so happy to do it. But I was already, even though I was a poor college kid at the time, I knew debt could be very dangerous. Sure. And to see our federal governments and all the other global big economies, they all are ringing that debt bell pretty hard. This is ugly. Be very careful of this. And this also leads to, you have to ask yourself, if we're running up all this debt, there's a cost. Yep. Just like if you run up, if you think about your own personal finances, you could go buy the best looking car. You could get a jet ski. You could get a boat. You get a trailer. You could get an RV to stay on the weekends. You can do everything $200 at a time because all they do is they just give you an interest rate. They give you an amortization chart that goes out many, many years to where you can afford anything $200 at a time. That's easy when interest rates are low. But what happens when interest rates start going up? The same question applies to our government.
That's exactly right, bro. I was going to say the same thing. As interest rates rise and as the burden of our debt load becomes greater and greater, there's going to be a natural tendency to either one, figure out ways to decrease the debt load, or two, figure out ways to decrease the interest cost, right? Like, how do we get the interest cost down? And it's really, really interesting. You can see, again, just thinking about the slope of this chart of how federal debt has changed, the practical implication of that is it's gotten significantly more expensive. And I would argue, Brian, maybe even more expensive than people thought would have been possible even as recently as a year ago.
Well, I mean, check this out. I had Daniel pull some numbers for us. The CBO. They do all the budgeting for the federal government. They started the year out at the end of 2021. They estimated the interest for 2022 was going to be $399 billion.
That's just interest paid on debt was going to be almost $400 billion.
Daniel was able to find, because look, we're now at the beginning of October, but Daniel was able to find the number from August. It had already ballooned up to $678 billion. Well, guess what? This doesn't even have the perspective that in September they raised interest rates another 75 basis points, or 0.75%. This number is going to be well over $800 billion if you think about the track we're going with the interest increases. If you did your own personal budget, and remember, these are billions of dollars, and you estimated in your personal budget for the year $399 billion, and it's going to be $800 billion. Where does that come from? I mean, this is a problem, and this is also a problem with how interest rates can stay at this level is because governments are going to have to come squeeze the balloon or figure out either cut through to find some way to cut or either raise taxes or just run up more debt. This is a true problem that I want you to know is ugly, and you need to be aware of this.
Another ugly problem that we already talked about, that the mortgage landscape is getting more complicated, right? So that is sort of a subset. It is more complicated in terms of the decisions you have to make to get a mortgage. But specifically, if you're a young person, or if you're someone trying to get into your first home, this inflationary environment has made what was already a pretty arduous task significantly harder over the long term.
Well, we put numbers to this. I mean, and I want to talk about what is often unsaid, the hidden problem or the secret problem with this. But Bo, walk them through. We took what was just happening, and what I think is crazy, 2020. I mean, that was a blink of an eye. Now, yeah, I know we had some crazy stuff going on with the pandemic, but from a memory, from a time, that was just a blink of an eye a moment ago. And check out these changes.
Yeah, think about this. In the second quarter of 2020, the median home price in the U.S. was $323,000. So if you put 5% down on a 30-year mortgage,
first home purchase,
at 2.5%, and this is realistic. You could really put 5% down and you could get a 2.5% mortgage. The buyer, the purchaser, would have a monthly mortgage payment of principal and interest of a little over $1,200. Now you fast forward just 2 years into the future, the median home price in the United States now is $440,000. Well, if that same purchaser wanted to put 5% down and wanted to do a 30-year mortgage, their rate's now 7%. So that buyer 2 years ago that was buying the median priced home in this country that was paying $1,200, now to buy that same type of home, that buyer is going to pay almost $2,800 a month in principal and interest.
I mean, think about it. That's 130% increase.
2 years.
That blows. That's just, and that's what we have so many discussions here internally with all of our young associates, young content team. I mean, I know. I mean, this is the ugly part of it. It's so hard to get on the home ownership train now. But I got to tell you, there's a hidden, unspoken problem with this. Is that how much of our system is a step-up system, meaning that, okay, you buy your first home with a 5% down, and then you live in that house for the 5 to 7 years, but then you start having a growing family. You you grow
upgrade.
into it.
Yeah.
I'm into my third home. I mean, you think about it. I had my first home purchase, upgraded one more time, then I've upgraded now to this house. That is 3 home purchases, 3 step ups where I got nicer, bigger homes every time. If you're in that house that you put down 5% and you have a 2.5% mortgage, how do you leave 2.5% mortgage?
It's going to be really hard to leave a 2.5 to go to a 7%.
That is going to create some weird ripple effects because people who were thinking about upgrading might stand still. They might say, hey, we'll just do home renovations. We'll just stay here. We've seen that with some of the people we work with on the content team. They, former neighbors and other things, we're going to put a new wing on the house.
That's right.
Because why? We're going to add to the garage. I mean, I get it. This is something that I think is going to be ugly because the normal cycle or change is going to be disrupted by this interest rate environment. And that's something that's ugly and we need to be aware of and you need to be paying attention. Now, I'll give Nate.
I was going to say the same thing because this sounds so bad.
What does this mean? I mean, and I was like, at some point, you're going to hold your nose and you just got to buy. I mean, even that's why you got to make sure you're staying in there the long-term period. And look, the good news, and that's why we are about to transition into the good news, but because I can't stand in on the bad stuff. This has happened before with high interest rates. Right. You'll hold your nose. Interest rates will go down. You'll be able to refinance later into a lower rate. But right now, it is tough. It's ugly. And what's going on in the housing marketplace.
And then here's another ugly thing, right? So housing is obviously ugly. What's going on the federal level from a fiscal standpoint is ugly. But if you look at what's going on in the stock market this year, it's been fairly ugly. We just closed out the third quarter, and it's not looked fantastic. We are fully in bear market territory this year, and so we're seeing headlines like this. The stock market rout looks like the dot-com bust of 2000. How low could stocks go? Much further, says Wall Street analyst. Dow tumbles as America's prices keep rising. The Fed could crash the housing market. Bond market is crumbling. I mean, there are headlines all over the place suggesting how ugly the market is right now, and they're not entirely untrue. If you're looking at it in a very fixed window of time, 2022 has not been like the most fun year for most investors.
Well, I think it's what makes this really ugly is that when I've been managing money professionally in the past, diversification it's incredible how you could, like I remember the .com. Everybody talks about the .com, but what they don't remember, and this is what I love, is that having the experience of managing money in the 90s, heading into 2000s, is that yes, equities got crushed, but if you had real estate, you made money. You made money on real estate. Your bonds did pretty good in that .com. So the diversifiers in your portfolio actually carried you nicely to where I remember when we were managing money, even though the equity market in 2001 was down like 13, 14%, most of our clients were basically at break even because the diversifiers protected them in a lot of ways. What makes this so ugly in 2022, we know equities because they have these cyclical 2 out of every 10 years. We're going to hit these bear markets, these things that really hurts, but you're building. This is where the premium comes for taking the risk to get that reward. But bonds, because interest rates are going up so fast, bonds are getting squeezed and crushed in a lot of ways. And that's why when you see headlines like the bond market's crumbling, this is taking away diversifiers. This means even people who on a risk scale thought they were safe. Now, look, they're not losing. I don't want to get too out in front of my skis here where I say those bonds are crushing you. No, they're losing at a much slower scale than what equities are doing. But still, it's disheartening when even what you perceive as safe actually has vulnerability. That makes it a really ugly economic thing.
And here's another thing that I think is interesting. If you look at the S&P 500 year to date, you just look at the first 3 quarters of 2022, it's down a little over 25% as of 6/30. I think that this is such an interesting thing to note. There is a behavioral bias in the world of finance called recency bias. We always remember the things that have happened most recently to us. When you look over the last couple years, we saw a significant downturn in the fourth quarter of 2018. Market lost over 20%, but then it immediately came back. It made the money right back. So it went down, came right back up. Well, then from a market perspective, we saw COVID in 2020, where again, the market dropped and it immediately came back up. And so now we as investors have been conditioned to believe, oh, downturns are fast. They happen fast and they recover fast, and it happens inside of a quarter. This is really the first time in a number of years where we've seen an extended period of downward movement. And what I think has been so painful for the average investor is there have been fits and starts this year. First quarter was down, and then it recovered a little bit. And then second quarter went down again, and then it recovered a little bit. And then third quarter got hammered. We're forgetting that in those 2 out of 8 years that the market is down, this tends to be more of the norm, not what we saw in fourth quarter of 2018, not what we saw during the COVID downturn. We just have to remind ourselves of that as long-term investors, this is part of the reason why we receive the risk premium. This is why we make money in the markets over the long term, is because there's risk involved in the short term.
Well, I think you make a great point. I mean, even good years, inner year, there's typically, and I'm doing this off memory because we didn't pull this slide in. It's 13, 14% is what I had in my head is the inner year volatility. But it is true. I mean, this has been a more drawn out loss. And that's disheartening. I mean, we think about that for clients all the time. Is like, man, we just need them to keep the metal about staying the course on this because I know it really hurts you. But here's and you said something there I want to make sure that we're clear on because we're about to transition into that good news is that, yes, the downturn can actually be more prolonged, whereas we've gotten so conditioned to thinking it's all fast. But I do want to remind people, he wasn't wrong that the recovery actually is fast.
It's a V.
But remember, to get that fast V-shaped recovery, you actually have to stay the course.
That's right.
Do not let the ugliness of this, the disheartening where you win a few battles, but it seems like the war is lost because we keep going down further. Stay the course, and then we can transition into the good side of all this so you know how to really turn all of this knowledge into actionable information for your financial life.
So I think one of the big good things is as we're seeing rates rise, I think that there's going to be a return to normalized risk taking, right? We've been in this low interest rate environment for so long that a lot of conservative investors, I'm thinking like retirees, fixed income, cash holders, they've been pushed out on the yield, out on the risk spectrum, trying to chase yield, trying to chase yield, trying to chase yield. Well, if we get back to more normalized rates on conservative fixed income, interest-bearing type holdings, perhaps investors as a whole can come back on the risk spectrum and won't be so far out. It will more normalize what a true risk-reduced or risk-off portfolio should look like versus what it's looked like over the last 5, 7, 10 years.
Well, I like to because I mean, we get comments from people who are obviously close to retirement and they get stressed out because I know some of our content is it's supposed to be motivational. It's supposed to get people to think like a financial mutant. And I could see how somebody who is in the retirement kind of window right now, either you're in retirement or you're approaching quickly, you could be like, man, this is really, I don't love how this feels for me right now. And what I don't like is we always hear about safe withdrawal rates, that 4%, 4.5%, 5%, depending upon when you're thinking about retiring. How do you get that? Because we actually practice a total return where we take actually appreciation as well as income. But if you're just trying to live off the income,
it's been hard.
It has been practically impossible because, and the only way that retirees have been able to get that safe withdrawal rate is really to mainline risk. You have to go buy equities, take the dividends from that, but also take the capital appreciation and diversify it over time. Because if you were just doing bonds or cash, you're making less than 1% or 2%. And that's just not getting you even close to your safe withdrawal rate. And look, if you want to look at this, cash now, I at least like.
Daniel titled this "Cash is less trash."
Yeah, I mean, because cash is trash. How long have we been hearing that? So cash is now less trashy because you now can get at least closer to your safe withdrawal rate. That's a good thing. And the long term. Now, look, as I talked about earlier, you have to be very concerned about inflation and what that's doing to purchasing power. However, I do love the fact if you can design a plan with a 4.5% safe withdrawal rate, in your planning process, it's nice when you're risk-free or things that you want to count on. You can actually use that diversifier, allocate enough money to it, and know no matter what happens, even if the market's getting crushed, you've got enough safe stuff to get you through the next 3 years. You're going to be great. That is a healthy thing in the long term to have that balance of risk and reward with safe assets versus risk assets. This is actually a positive or a good thing.
And I think it's going to reinforce the correct type of behavior. How many folks, Brian, have we heard have said to us, yeah, I know you say 3 to 6 months of emergency fund, but man, my cash is doing nothing. I got a month and I'm going to invest the rest because it's just not earning anything. That's a dangerous place to be. So hopefully, as we do see yields on risk-free assets like cash and high yield savings accounts and money market holdings increase, people will return back to the appropriate level of risk. You will actually abide by the financial order of operations and keep that 3 to 6 months in an emergency fund and not have to hold your nose while you do it, because it is going to generate some sort of return, some sort of interest for you over the long term.
Well, and let's now pivot to, because the first part of doing cash and safe assets correctly is making sure, what are your cash reserves? How much would your asset allocation look like? Because once you know those numbers, you can also set guardrails, because what I don't want you to figure out, what if you figure out your cash reserves, is it 3 months, is it 6 months? If you say it's 6 months, once you have that 6 months, don't be, because I think a lot of people will be like, hey, maybe I'll go to 9 months or a year.
Maybe I'll get a year of cash.
Because, cash is paying now 3% or 3.5%. No, once you figure out you need 6 months cash reserves, do try to protect yourself to stay to that, because now I want to transition to, we all hear the adage, buy low, sell high.
Yep.
But nobody really does a good job of explaining, what does buy low look like. It's gotta hurt. It's gotta hurt. So that's why I want you to have boundaries to understand what cash, what safe assets should look like, because the contrarian, the financial mutant opportunity is, now let's talk about risk assets and the good with volatility. The good with bad news is that pessimistic situations create tremendous opportunities for anybody who's got that optimistic long-term outlook.
That's exactly right. If you're someone in the accumulation phase, if you're someone building, or perhaps maybe you're even in retirement, but you're looking at your allocation, you're looking at the way your portfolio is structured, and you recognize maybe it's not been where it needed to be. Maybe I did allow myself to get too conservative. Maybe I did allow myself to be too scared of the markets. Recognize right now there's a huge opportunity that things are on sale. The market is on sale. And even though it feels uncomfortable, even though it is scary, if you can be that contrarian that learns how to be fearful when others are greedy, and right now greedy while others are fearful, you can capitalize on this. And you've seen this illustration 1,000 times before if you've been watching us for any period of time. But we all know about the Great Depression. It was this 25-year period where the market essentially closed at this point, and then 25 years later it closed, and it had not moved at all. It was this giant crater in the market. Well, if you would have just bought on the day before the Great Depression started, and then you would have just held it for 25 years, yeah, your portfolio is not looking incredibly great. However, if you could figure out how to power through that volatility, and you could have invested consistently, in this illustration we use, we say $10,000 invested each year, starting in 29, going all the way through 54, even in a period where the market seemingly did not make money, you could have annualized almost a 12% rate of return because of the opportunity that volatility provided you.
I can't remember if it was on Twitter or if it was on our YouTube comments, but I was like, this person's got to be clowning me, because they said, well, problem with the way you guys do your content is you always assume the economy's growing. What if we hit that period from 1929 to 1954 where the markets made nothing? And I was like, he's clowning me. He doesn't
Surely,
know.
Has he not seen this
He's
episode?
either part of the 40% that's discovering us every month, or this is a financial mutant trying to give me the biggest softball opportunity to kind of lay it out there, because they're exactly right. And in 1929, in September 3rd, the Dow Jones was at 381. And then you fast forward to if you think about that, that is 25 years in the future. Fast forward to November 23rd of 1954. That's almost a full generation ahead. It's 383 again. That's less than $2
$2
difference between there. So you hear that and you're like, oh my goodness, the economy just wasn't growing. But as Bo just shared with you, if you just dollar cost average through that volatility, you would have averaged 11.7% per year. So volatility is your friend. If you think about this, and by the way, I also want to put an exclamation on this opportunity because we're about to show how fast things recover. But I do want to remind everybody, we buy into the law of accelerating returns and the fact that if you look at how good things are growing, the innovation, the way technology is changing, it's not slowing down. It's actually accelerating. If you think about what happened from when I was born in the 70s to what we're now doing in 2022, take it to the difference of when Bo was born in the 80s and what has happened now. But more stuff has happened now. I mean, it is accelerating to where in the next 10 years could look like the first 25 years of it makes it look like it's standing still. That is going to be something we're going to be able to profit off of. It's going to be something that globally will expand the economy. Nobody has to lose for opportunity of a growing expansion of innovation. It's human nature. You need to be on that ride because, look, and this is a great time to hear this information, absorb it, and see how you can maximize this potential for you because we shared earlier, the market is down 25% right now. But I want people to understand markets recover quick. And here's the thing I need. You see that most bear markets, I told you, 2 out of every 10 years, you're going to have down years. You usually have a bear market as part of that. And I want people to know when you have bear markets, they do average around 35%. You're like, wait a minute, guys, you just showed me we're down 25. That means it could get worse. Yes, it could. It could get worse. Very well could. But here's what I need you to understand on when it gets worse. It could get worse all of a sudden, meaning that we have dragged along here for 10 months now, and we've expanded this. We've had some fits and starts of things recovering. But when it does get to the bottom, we might be at 25, and we all of a sudden, the market can next week, 2 weeks, 3 weeks, it could all of a sudden lose another 15%. Sure. But here's what I do know. When we hit that dead bottom, 1 month later, the recovery's on average close to 15%. Yep. 3 months later, it's 21%. Fast forward 12 months, close to 44%. 24 months, we're close to 63% recovery. So what I'm telling you is, this is not a bad time, even if we have another 10 to 15% to give back, because when you start always be buying, if you're dollar cost averaging, just like we showed on the previous slide, if you're buying low consistently right now, when that thing whipsaws with the V-shaped recovery, you're going to be so happy that you are always be buying and not letting yourself get distracted with the negativity of the press, with how your portfolio looks on a monthly basis right now. All that's going to seem like distant bad memories because you will have bought low. So you have the potential down the road when you need the money to sell high. That's incredible.
Here's what I think is so scary about this, though. If you start trying to get cute, and if you miss it, look at this. In the first month, on average, it makes back 15%. But if you look at the first 3 months, it makes back 21%. 2/3 of that first 3 months return happened in the first month. So if you miss it, you're out of luck. Think about this. In the first year after the recovery, market on average makes 43.5%. It made half of that, 50% of that return in the first 3 months. So you have to be there when it turns, or you miss out on the good stuff. You miss out on the rapid recovery. So there's a reason that Warren says, learn how to be greedy when others are fearful, not learn how to be kind of greedy when everybody's like not super worried about things. That's not the way that it works. That's why when you design a portfolio, when you design a strategy, you want one that's really good before the stuff hits the fan, that stays really good while the stuff is hitting the fan, so that it will continue to be good after the stuff has gotten out of the fan.
Well, and I think it's also, we're in this time now that interest rates are going up. In addition, it gives this false soothsaying opportunity. You used to be like, hey, at least I'll just wait for the dust to settle. I'll stay in cash because at least cash is making me, I can't lose money in cash. I'm getting 3 to 4% on my cash, with what the Federal Reserve is doing. But here's the reality of the situation. Remember, purchasing power at the end of the day is what you're worried about. Right. What will your dollars do in retirement for you? And I know that, yes, equity returns can be volatile. But if you have a nice diversified approach and you know that you have at least half of your assets working in growth risk opportunities like equities, that since 1980, the S&P 500, which is a great kind of, if you want to look at a benchmark or a way or proxy to figure out how you look at equity investing, and you can see since 1980, annualized 8.98, not return. That's 8.98 after inflation. Guys, that's protecting purchasing power. So hang in there on this volatility. You're going to be okay. You just got to stay the course, have the strength to know why you're doing what you're doing with your money so that it can actually have the maximum opportunity to be fulfilled and really turn into the best version of yourself financially.
Yeah, I want to say it a little bit differently because we hear since 1980 and SP's done it. I want you to think about this. Since the last time, before this last year, the Georgia Bulldogs won the national championship, since the savings and loan crisis, since the dot-com bubble burst, since 9/11, since the Great Recession, since COVID, since fill in the blank on the thing that's happened over the last 42 years. And the market has been incredibly resilient as a method and mechanism to protect your purchasing power over the long term. Could this market get worse? Sure. Could there be other scary things that happen? Sure. Have we seen these types of things before? Yes. Has the market proven over time that it rewards those investors that can stay level-headed and disciplined over the long term? Absolutely.
Guys, so, I want to make sure you know that we load you up. Just like we're talking about interest rates and what that means for you over the long term, short term, the good, the bad, the ugly. I want you to use our resources. We have tons of free stuff. If you go to moneyguy.com/resources, you'll see we have tons of free stuff. If you like what we're giving away here, you're going to love what we do on the free deliverables. And then if you're somebody who needs a little more instruction, you need something that's a little more curated to kind of accelerate your success, take you into the fast lane or level you up, I want you to go to learn.moneyguy.com because we have courses, we have tools. If you think about net worth, I'm getting close. In fourth quarter, I start just twitching that I can't wait to do.
Even in years like this, I get excited about it.
Even in a down year, I'm excited to do the net worth statement. We have a tool, the net worth tool, that lets you not only do a net worth statement, but have a dashboard tool that will help you know what metrics you should be watching. If you think about the financial order of operations, we've created the better mousetrap to know what to do with your next dollar. I want you to go figure out how you balance the risk, the reward, what you do with cash. We've got the 9-step process. This is one of the free deliverables. If you go to moneyguy.com/resources, you can download this free deliverable. But also, if you go to learn.moneyguy.com, we have a course that will, in a curated way, with tools, with homework, will help you reach that goal even faster. And then I'm happy to report we also have a lot of you are probably in that early stage of your building. You're trying to figure out what's the financial plan or the napkin plan that will tell me, begin with the end in mind. What's my number? What am I saving for? We have a brand new course called Know Your Number, and I'm telling you, this is going to help you once again accelerate, fast track, and know exactly what to do with your money so you're prepared no matter what's coming your way. Just like Bo said, you got to have a plan that's good at the beginning of what happens, through all the as he calls, the stuff hitting the fan, and even when you're looking in the rearview mirror and things are good times. These are the tools. This is the stuff that's going to help you. And maybe you're close to retirement. I talked about my retirees or people quickly approaching retirement. We work with clients all across the country. Everything we have on this show is to help you plant those seeds of knowledge, learn, apply, grow, reach the abundant cycle graduation point where you actually need to work with a financial advisor. We can't wait to hear from you. You can go to moneyguy.com. You can go to aboundwealth.com. We have a work with us section. We will load you up.
If you don't follow us on socials, go check us out. You can subscribe on YouTube. You can subscribe to FYI by FTE. You can go check us out on TikTok, Twitter, Facebook, Instagram. We'd love to connect with you there.
I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team, out.